Hello, my name is John Seguin, and I am an owner and creator of Macrograph. That's me you see overlooking the trading pits at the CME Group in Chicago. I've been in the business for about 32 years, 20 of which were on the trading floor at the CBOT, mainly in treasuries, and I also spent some time at the S&P pit at the CME. As a broker, my main duties were to report price action and execute trade for proprietary traders, banks, fund managers, sales staff, and clientele from all over the globe. Back in the mid-'80s, I was fortunate enough to attend one of the first classes given by Pete Stottlemyre, who was the inventor of Market Profile and the Market Logic School. Market Profile is my short-term tool of choice because it organizes price action into bell curves, which I believe allows the user to see in charts what we used to see in the trading pits, which is the auction process in its most basic form. For those of you who are unfamiliar with Market Profile, I'll give you a quick rundown on how daily price action is organized into bell curves and how to interpret some of that market-generated information. First, as the chart shows, we assign a letter to each 30-minute period of the day. In this slide, there are two charts. The first shows what a bar chart would look like if each half hour had a designated letter, and we plotted them parallel to each other. The second chart is a market profile, which is the structure you get when the bars are stacked together. This allows us to track time and price. Note that all the letters from A to H traded at the price of 16. More time was spent at this price than any other. This is considered the fairest or high volume price and is instrumental when determining fair value. For profilers, this is an important concept. Price plus time equal value. The more time you spend at a price, the more volume accumulates. By organizing price action into profiles, we can also determine if bulls or bears are in control of momentum. Momentum begins and ends at high volume prices. Naturally, we can assume that sellers are in control of direction if a market closes below the fair price, and conversely, bulls gain the upper hand if there is a settle above the fair price. This is the most basic read on momentum. There are other clues that help us interpret momentum, but that would be addressed in a more detailed lesson. This is only meant to be an intro to the concepts and logic. There is a wealth of information in each profile. Like most technical tools, each bell curve has an open, high, low, close. But they also illustrate other dimensions, such as the high volume price, value area, time at price, extremes, early balance, and range extensions. I realize these terms may be puzzling, but it is important to understand them when utilizing a pragmatic approach to trading. The trading floor is a highly competitive environment, and if I was not prepared to answer a client's questions and execute trades in seconds, they would hang up the phone and call another broker who was prepared. Consequently, I designed a checklist that focuses on the most common questions I was required to answer on a daily, even hourly basis. As a matter of fact, and necessity, this was the format from which I designed Macrograph and the VERTEX trading series. There are many types of traders: speculators, day and swing traders, hedgers, and spreaders, to name a few. Generally, they were all looking for information from the pit. Where is fair value, or at what price are buyers and sellers trading most often? Who is controlling momentum? Are the big firms such as JP Morgan, Goldman Sachs, Citibank buying or selling? Where is good trade location to buy or sell? Once in a position, what is my risk? Or at what point will momentum turn? Is the timing right for a trend to begin, or is the market in a consolidation phase? How far is the market likely to travel, and how do I protect that profit in a trending market? I was able to have a successful career as a broker because I could answer these questions, and I could do it in any time frame. My opinions were not always right, but my information was consistent and reliable. As an analyst, I concentrate on recognizing repeatable patterns and probabilities. Any analyst that says they have all the answers is either lying or fudging their numbers. I came up with an easy to remember acronym called VERTEX. Each letter covers the components from the trader's checklist. V for value, E for energy or momentum, R for risk, T for timing, E for entry, and X for exit. It is important to address each element before entering a trade. All great traders study the characteristics and traits of the markets they trade. By doing so, we should be able to take advantage of opportunities when they present them. I played baseball in college, and we spent countless hours not just practicing, but practicing situations. As a pitcher, if a ground ball was hit to my left, I ran to cover first base. Or if a runner was tagging from third on a fly ball, I ran to back up the catcher. Eventually, when the time came, I would react almost instinctively. Like an athlete, a trader must prepare for any situation, and that comes from practice and pattern recognition. The chart you're looking at is one of my worksheets I plotted by hand while on the trading floor. This not only allowed me to watch value develop in real time, but I also noted when momentum kicked in and who moved the market directionally. Each profile shows the open, high, low, and close, high volume price, fair value area, early balance, extension after balance, and time at price. Under each bell curve, economic reports that impact prices are noted. I also kept track of average ranges by day, week, and month, which allowed me to keep tabs on how far the market might move in a given time frame. My point is that I designed Macrograph and my lessons to give you all the tools you need to become a successful trader. When I used to day trade futures, I often did many round turns in a few markets, usually 10-year notes, 30-year bonds, or one or two of the equity indexes. And I rarely went home with a position. Now that I'm older and I believe wiser, I avoid day trading and prefer to search for longer-term setups that frequently require me to carry positions for days. I still use short-term signals and indicators, but now I use them in conjunction with longer-term bell curves or macrographs. Rather than trade a couple markets all day, I search many markets in multiple time frames for repetitive and reliable patterns. With that, let's look at a few common patterns and we'll discuss how to use those signals to enhance timing for longer-term trades. I should tell you that I no longer use daily market profile, but I did design a charting method using 30-minute bars that illustrate all the pertinent information a trader requires to employ a pragmatic approach to trading. Markets give us all the information we need, we just have to learn to listen. There are countless structures, but we can break them down to a few patterns that repeat often and tell a story. Most days can be labeled as directional, neutral, or breakout. Let's take a look at each type using market profile. Then I will show you how I use 30-minute bars to gather the same information with a few more bells and whistles. Directional profiles are the most common. They typically have an extreme, which are consecutive low volume prices at the high or low. Take a look at the profile on the left. The open is shaded pink. What this shows is that sellers are so aggressive at the open that the market spent little or no time at these prices. If you were watching a trading pit, you would see nearly all the brokers with their palms facing inside the pit, which means they are offering or trying to sell. Such activity often leaves a selling extreme. In contrast, if traders' knuckles are facing inside the pit, they are trying to buy or bidding the market up. In this case, a buying extreme tends to form. These low volume extremes often give us our first read on momentum. The bell curve on the left indicates that bears are in control, and the right tells us that bulls are active. Another indication of momentum comes from an extension of the range after the market has settled down and found balance early in the day. In market profile terms, this is called the initial balance. As a rule, most profile providers show the first hour of trading as that initial balance. I believe this to be presumptuous. On some days, early balance can take moments, and other days, hours. I use a formula to determine initial balance that I believe is logical and still conveys the original ideas of the market profile rules. The point is that when the initial balance is violated, we get another read on who is controlling momentum. In the profile on the left, the market opened at 19 and aggressive selling left an extreme. The black box shows the initial balance area. You can see later in the session, sellers pushed the market below that balanced area, which gave us a second read on momentum during that trading session. If a market extends above the initial balance, it is a sign that buyers are in control of momentum. And the third indicator I use to interpret momentum from a day view depends on where the market settles with regard to the high volume prices. Logically, a settle below fair value suggests that sellers are in control, and if there is a close above the fair price, buyers have the edge. When using the indicators such as extremes, extensions after the initial balance, and closes relative to the high volume prices, we can make assumptions. For example, Let's interpret the profile on the right. Buyers were active early because they left an extreme. They were active later in the day when they bid the market above the initial balance, and the close was above the fair prices as well. We know bulls were in control of momentum throughout the session. Therefore, we can assume that the market will probe higher in search of sellers. The risk is that we will see higher prices in the next session before the market dips below the bottom of the value area. In a down market, risk is often defined by the top of the value area. We'll cover more about defining risk later. We covered directional days. Now let's review another common structure that is considered a neutral type day. These are common before big moves and trend changes. A neutral day often has extensions above and below the initial balance. Much like the middle profile on the page, neutral days tend to be well balanced and frequently have no extremes or consecutive low volume prices at the high or low. Their value areas tend to be below average in length, and the high volume price is often seen in almost every 30-minute period of the day. Lastly, few neutral days often settle near the high volume prices. They signify impartiality and tend to come in bunches before trend reversals. The last pattern we'll cover is common after neutral days and often signify breakouts. These type days often have a far below average initial balance. Price tends to accelerate and volume jump as they extend through the initial balance and leave behind single prints or low volume pockets. Reversals are small as the market moves in one direction all day. I call them sprints. They happen fast, and if you combine single and prints, you get sprints. They are frequent at the beginning of trends. I realize market profile is not offered by all chart providers, and that it can be expensive if it is available. But all of them do provide bar charts. So I created a charting style that illustrates all the pertinent data that a bell curve would demonstrate. Let's take a look at a few of my daily worksheets. In this slide, each box you see is a value area that encapsulates the high volume time of the day, which is generally the regular trading hours. Like letters that distinguish 30-minute periods, each day has a designated color, which is valuable when trying to recognize patterns. The bright yellow rectangles show the initial balance, and of course, the open, high, low, close are displayed as well. Remember I mentioned that neutral days are common before trend changes? Well, in this NASDAQ futures chart, there were 3 consecutive neutral days before a bullish directional pattern formed on Thursday. There was an early extreme, an extension above the initial balance, and the close was within the value area. 2 of the 3 daily momentum indicators tell us that a long position is likely to pay. Let's take a look at a few other examples. In this gold chart, take a look at that Tuesday with the letter A above it. An extreme formed during the initial balance, there was an extension lower late in the day, and the close was below the value area. The result is 3 negative momentum reads, which means odds favor lower prices over the next 16 to 24 hours. Then on Wednesday, we saw another selling extreme in the initial balance, plus an extension lower and a soft close. Hence, another session of lower prices is apt to follow. A few days of consolidation ensued. Then if you look at the day below the letter B, you'll see that the entire day range was set during the initial balance. Remember, these are common before big moves. This day was followed by a trend type day which left a sprint or a set of single prints, which is a powerful statement from sellers in this example. This was followed by yet another directional day down. Note how the market moves from balance to imbalance and back to balance. In this S&P chart, under the letter A, we see a Monday where the entire day range was set during the initial balance, which indicates neutrality. It was followed by a bullish directional day. Notice that the market moved higher until it enticed sellers. And we know that because under the letter B, you see a selling extreme shortly after the open. There was an extension lower after the initial balance, and there was a soft close. This response proved that sellers considered the market rich. Notice that sellers were active for the next 2 sessions. All the information you need to analyze a market is there. We just have to learn to listen. This natural gas chart shows a couple neutral sessions under the letters A and B before breaking into a sprint higher, which was the onset of a bullish trend over the next 4 sessions. And the last example is a corn chart that shows a neutral day under the letter A. which was followed by another neutral session before a directional profile showed the way. High-frequency trading is exhausting and not nearly as profitable as the old days in the pits, where an occasional edge was available. By edge, I mean that speculators were able to buy on the bid side or sell on the offer side. Now that trades are executed electronically, it is rare to get filled up on a position without the market printing through your price. The way I figure, patterns repeat in all time frames and in all markets. And as traders, it is our job to find a style and time frame that makes us comfortable and fits our pocket. So I took the same proven logic from watching daily price action in the pits and applied that knowledge to longer-term bell curves or macrographs. In the next video, you'll learn how macrographs take shape and how to use them to create or enhance trade strategy.